Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest is Alex Kech, CEO of the Global Legal Entity Identifier Foundation, or GLEIF. It's a role for which he's uniquely qualified, having spent 18 years at Swift, where he developed an enthusiasm for the value of standards which has lasted throughout his career. Alex spent 7 years in the digital assets industry, building the Singapore-based digital asset custodian and prime broker, on-chain custodian, advising City Ventures on blockchain use cases, and most recently was head of digital securities at the SIX Digital Exchange in Zurich. Unsurprisingly, it was Alex who convened the ISO TC68 working group that produced the ISO 24165 Digital Token Identifier, or DTI, the first international standard for identifying tokenized assets. Alex, welcome to Future of Finance.
Well, thank you, Dominic, for having me.
The original use case for GLEIF was counterparties in the OTC derivative markets following the great financial crisis of 2007 to 9. We're now more than 10 years on from that, and we have digital assets and cryptocurrencies have become another use case for LEIs, for legal entity identifiers. Now, what value do identifiers invented in a traditional marketplace bring to digital asset markets? And by digital assets, I mean not just cryptocurrencies, but stable coins, security and fund tokens as well.
Well, the LEI brings to the digital asset space exactly what it had brought to the OTC derivative industry and capital market industry more in general after the 2008 crisis, which is a globally recognized, regulator-endorsed identity layer for legal entities. And in the space of digital assets, this is clearly a requirement, a need as this industry is becoming more and more regulated and more accepted in the traditional finance ecosystem. And that's reflected by the fact that it's also part of regulations around digital assets like MiCA or money laundering regulations or FATF travel rule requirements, because it fits well, actually even better in the space of digital assets. Blockchain is cross-border by nature. It transcends jurisdictions most of the time, which sometimes leads to issues. And having an identifier that works globally fits perfectly to the needs of compliance, of identification, of verification that the digital assets space has as it becomes more and more used by players such as banks and others. And as it scales.
You mentioned that digital assets are regulated differently in different jurisdictions. They're also, of course, issued onto different blockchains. And one of the major challenges which has emerged in the digital asset markets is the difficulty of moving digital assets between those blockchains. And that sounds like it might be an opportunity for GLEIF. And if it is, what are you doing to assist that process of interoperability?
Clearly, this is a very, very good standard for interoperability for many reasons. It's not only enabling interoperability between traditional finance where it's used and blockchain finance where it is becoming used more and more as a way to bridge between traditional and new finance, but technologically it also enables it's platform agnostic and it's blockchain agnostic in a sense that it really enables identification of legal entities wherever they sit on the blockchain ecosystem and on the platforms. And with the VLEI, which is the verifiable legal entity identifier, which is a digital version, a cryptographic version of the LEI, it actually brings verifiability on any platforms that leverages the VLEI system in the sense that it can be plugged into blockchain A, blockchain B, blockchain C, enabling portability of identity and portability of attestation and credentials linked to that and entity and identity. In terms of interoperability, it's been historically doing so in a sense that the LEI is also a connector between identifiers. So today we have identifiers, well, the LEIs that is mapped to other entity identifiers like the GLEIF, to other instrument identifiers like the ISIN and DTI as well. And it really aims at connecting identifiers that are all going back to a legal entity and ensure that there's a consistency and an interoperability between those various identifiers, wherever they sit, whatever platform they are used on, and whatever blockchain they are used on as well.
Now, when GLEIF came into being, as you've just alluded, BIC codes, ISINs, the problem was to identify counterparties and securities. One of the things that blockchain does is it brings smart contracts, things which are embedded into the tokens, embedded into the infrastructures. And I see that GLEIF has published a research paper, a joint research paper with Key State Capital and the Cardano Foundation on verifying those smart contracts, these automating pieces of software that underpin all digital assets. Now, what exactly is the problem with smart contracts that LEIs can address? And how does the solution which you have created with Key State and Cardano actually work?
Sure. So smart contracts can be, especially on public chains, can be deployed by anyone, by you, by myself. There are tools to do that, and sometimes by bad actors as well. So we've seen that recently with the JP Morgan dollar token. As soon as it was published by JP Morgan that they had created that token on the base blockchain, although it's not tradable, you had copycats, fake copycats JPMD that has been issued within an hour on other blockchains, being available on DeFi protocol for trading, though obviously they were not available for trading legally. So it led to actually millions of people, millions of dollars to be injected into fake tokens. So verifiable smart contract is really about ensuring that when you invest into a token, which is a smart contract technically, you can automatically verify that you're not investing or pouring money or buying something that is not issued by the legitimate issuer. So that's one verification process that the verifiable smart contract can enable. And how it's done, it's through what the verifiable legal entity identifier, which enables an entity to verifiably prove who they are, but also to verifiably sign smart contracts or other data sets on blockchains or elsewhere, and cryptographically link that smart contract, in that case, to themselves in a way that you are 100% sure that that smart contract is controlled by that legal entity and has been issued by that legal entity. It can even go to the level of who has done it, because the VLEI enables also a cryptographic delegation of authority, meaning that a CFO, for example, could digitally sign a smart contract in a way that you know that it's the CFO of UBS, for example, who has the authority to issue the UBS bond that has been issued by UBS, for example. So it's quite strong. It's quite robust. It enables to fight against fraud. It enables security and cyber security around tokens, not only for tokens being issued, but also for in the future for services that are smart contract based, like a Uniswap, for example. There are copies of Uniswap all over the blockchain space because people try to attract liquidity in a fraud manner. That can also be used to ensure that a service you use, a DeFi service you use on blockchain, is legit, is controlled by the legal entity that is behind it officially.
You've begun to talk about this question of identifying counterparties and identifying tokens. And as I mentioned in my introductory remarks, you were involved in the development of the ISO 24165 standard for digital tokens. That's now a couple of years old. There's a registration authority in place, the Digital Token Identifier Foundation, the DTIF. My question is, you tell us a bit about the token if you like, about the standard if you like, but is it, more importantly, is it being adopted by participants in the digital asset markets?
So, well, the good news, I guess, it's always a good news for a standard, is that it's being adopted by regulators. So regulators are, ESMA in particular, is adopting the DTI as an identifier for digital tokens, and that's always the first interesting push for a standard, is when regulators supports it. And in terms of usage by the industry, it's progressive, as every standard. but we see adoption. What we definitely see is that digital token identifier have been issued for thousands of tokens today, and that more, let's say, traditionally regulated entities issuing tokens, for example, SDX, where I used to work, are getting and obtaining a digital token identifier for the assets, the digital assets they're issuing, as a proof that they exist, and as a way to also provide a standard way to represent that token and ensure it's not confused with another token. And recently, I guess one of the key milestones of the DTIF, so the Digital Token Identifier Foundation, of which I'm a member of the Product Advisory Committee, is that they've done a partnership with the Association of National Numbering Agencies, so ANA, who is behind the ISIN standard, which is great because it's actually bringing an association between an interoperability, a seamless interoperability between an instrument level identification, which is the ISIN, and a very much used in the traditional markets, as you know, and a token level identification in the blockchain based market. So that interoperability is also quite great. Of course, there are other standards in this space, if I may add. So there are technical standards like the ERC 3643 in the world of EVM compatible blockchains, which are still relevant, but can be enhanced by having a DTI associated with the token as part of the ERC 3643, having the VLEI and LEI as the identity of the issuer of that ERC 3643. And that's exactly what the association behind that standards is doing as we speak, and partners like Chainlink, with who we've developed a compliance tool leveraging the VLEI, has understood and ensured that bridge between traditional and blockchain-based system with existing standards like ISIN and LEI, new standards like the DTI, and technical blockchain standards like ERC 3643.
Something I don't think you've mentioned is that the LEI of the issuer of a digital asset is now part of the ISO 24165 standard. Am I right to say that? And if so, how does that help?
Absolutely. I was waiting for you to ask me that question. So indeed, the LEI has been included as part of the revision of the standards that happened last year to be a element of the DTI, and it makes a lot of sense based on what I've just said before. Behind most digital tokens, they are an issuer. Of course, with the exception of Bitcoin, because we know Satoshi Nakamoto is not a legal entity, but most tokens, even the blockchain tokens, have either an association behind it or a decentralized organizations behind it, who can now, in some jurisdiction, be identified as a legal entity. And having that legal entity identifier behind every token, again, bring verifiability of who is the issuer is, bringing transparency, real-time risk assessment of tokens, and we anticipate that it will also help with the adoption of the DTI. And going back to what I just explained about verifiable smart contracts, if in addition to the LEI behind the token, you can have a VLEI cryptographically binding that token to the legal entity in a verifiable way on blockchains, in plural, enabled by Chainlink CCIP protocol, so enabling portability of that information across chains, for example, you end up with a scalable, controlled environment that regulated entities can trust, because they can verify control, they can verify entities behind tokens, and they can verify that they're investing in the right assets and not fraud tokens or fake tokens or any other tokens they wouldn't want to touch for legal reasons or compliance reasons.
You alluded earlier to the fact that digital asset firms are subject to KYC, anti-money laundering, countering the financing of terrorism, and sanctions screening rules. What the industry knows collectively, I suppose, is the travel rule. Now, that's become a major pain point in traditional finance, has been for many years, onboarding clients, running them through those various checks, and has now become a problem in the digital asset markets as well. Yet the problem which those various checks you're trying to solve is actually a very straightforward one. You're trying to verify the identity of the customer you want to onboard. Now, in theory, in principle, LEIs have an obvious role to play in that. My question is, are LEIs playing a role in customer onboarding or identity verification? If so, how are you doing it?
Clearly, so the LEI is not a KYB system, right? It's proving the existence of an entity and link and publish in a standardized way a data set that can be used to across jurisdiction compare entities and link them also among themselves. So you know who is who, and you know who owns who, and who is associated to who, which is quite useful when you do an onboarding. It's an initial step of a KYB, so or a KYC. So clearly, LEI is being used by banks. Some are even becoming validation agents, for example, when they meaning that when they onboard a new customer, if that customer doesn't have an LEI, they ask. They leveraging their onboarding process to get an LEI for that entity to then be able to monitor the status of that company as it grows in as they deal with that entity over time. And we recently in the specific space of digital asset, we recently worked with GDF and Zodia Markets, which is a player in the digital asset space, to exactly demonstrate that the integration of the LEI and the various APIs and live updates of information that the LEI system enables into an onboarding process and into a monitoring process of a customer helps reducing significantly the time of onboarding from weeks to days. In the case of the use case we've illustrated with Zodia Market and the global digital finance colleagues, which is considerable. That's one side of the project, the parts. Once you have LEIs for all your customers, you can then more easily integrate them into other regulatory requirements, like the travel rule. If everybody starts identifying their customers, so as ordering customer or beneficiary customers with their LEIs, it enables false positive when you do scanning or screening. It also helps to have clarity between, okay, this LEI is linked to this wallet, for example, or this LEI is linked to this account if it's a bank account, in a way that prevents fraud, in a way that prevents issues in terms of FATF recommendations, in terms of money laundering and CFT screening. It brings clarity and transparency, in other words. And again, if you go back to adding the VLEI into it, especially on blockchain, you can then imagine moving from a identity-based AML CFT compliance approach to a credential compliance method, which enables progressively players into the same ecosystem to trust the KYC credentials that a customer has obtained from another regulated entity, in a way that it further accelerates the onboarding of that customer through the fact that its KYC status is verifiable through the VLEI credentials that has been issued to that entity.
Can you explain a little bit more what you mean by credentials-based compliance? And who, I think I know people got to produce credentials to prove their identity, but you might give us an example of what some of those are, but you might also tell us who you think is going to own and control and publish those credentials.
Yeah, let's take a very basic example of, I'm a bank, I have a VLEI representing me as a bank, and I would like to use that VLEI to issue verifiable credentials to my customers. And why would I want to do that? Because it enables them as a customer to prove to me when they connect to a system or to a trading environment that I have put in place that they have been KYC'd by myself. But it can also be used by those clients to prove to other banks that they've been KYC'd by UBS, for example. So that's what I mean by verifiable credential-based compliance, is having a system where you don't have to repeat all the time the same identity and KYC process with every entity you're dealing with as a client, as an asset manager, as a broker, or as retail clients even, you leverage a KYC process that you've already performed and prove that you've performed that KYC process with a verifiable credential that can be verified anywhere by anybody who would want to onboard you as a client. It doesn't mean that it's going to replace the full onboarding process, but it can accelerate that process so that in some circumstances, if it's for small amounts, you could imagine being okay by a client showing you a verifiable credential that has been issued by UBS. And then if he starts doing more trades with you and you want to do more due diligence, you can then start potentially enhance that profile with additional verifiable credentials obtained from other banks or your own credentials that you issue after a further validation of the status of that customer. So those credentials, in terms of who owns them, they are issued by a bank to a specific client. The client owns the credential in the sense that he has it in his wallet and he's in control of that credentials, and he can present it to whoever he wants to present it. That credentials can be automatically revoked by the issuer if something is wrong, either the customer suddenly appears on a sanction list, for example. So it's creating a very dynamic and autonomous and digital and automated way of doing compliance, way better than today, where a lot of processes are manual, a lot of processes are repetitive, and a lot of processes are failing, to be honest, leading to fines to banks because they failed to do it properly, and leading to also industries not scaling, especially the digital asset industry not scaling because of that friction that compliance can bring to processes in general.
Don't we need somebody to decide what is a valid credential for this process?
Yes, you would. So today we have two types of credentials in the VLEI framework. We have what we call official organizational role credentials. That would be for me as a CEO of GLEIF, for example, to prove that I am the CEO of GLEIF. So it's useful for signing contracts. It's useful to potentially sign transactions on blockchain on behalf of GLEIF, if one day we do that. It's based on authorized signatories. It's the concept of authorized signatories in the physical world applied to the digital world. But then we have what we call engagement context role credentials, ECRs. So engagement context role credentials who can be defined the way you need based on a specific context. So in the context of KYC, that credential could say, this client, 1, 2, 3, 4, 5, you don't necessarily need to provide its name, has a status KYC, that would be the context role credential, by me, Bank A. And that's all that credential would say. You could imagine having another ECR credential that says, this client, 1, 2, 3, 4, 5, is an accredited investor. Or this client is a non-US investor, which sometimes is a challenge for banks to onboard US customers. And all those credentials can be chained together. So they can build a profile of a customer in a way that all credentials are chained together, are verifiable through the chain, through the root of trust back to GLEIF as a root, ROOT, of trust, meaning you know that the system works. It had the credential has been issued by the bank. The bank has received its credential from a qualified issuer accredited by GLEIF, and this accredited issuer has been authorized to issue credentials by GLEIF itself. So you have that full cryptographic chain of trust that enables that compliance to happen this way.
And if a bank wants to access the credentials of a potential customer, or a potential customer wants to share its credentials with a bank, how do they do that? Do you need some secure, simple system to make these available? What's the answer?
So these are those credentials are hosted or held into a wallet, a bit like you would hold your stable coins or your crypto into a wallet. And the only thing you need to do is present that credential in a way, it's technically, I don't know, it would be difficult to explain how it works, but you present your credential which shows information. So I hold this credential that says that was issued by bank A with the status KYC, for example, and then whoever is presented that credential verifies the status of that credential. So the only thing that is in the public is the status of the credential, not the credential itself. The credential is in the wallet. It's presented to someone who needs to verify it. The verification will go into the public carry infrastructure, the key event receipt infrastructure, and we'll find whether the status is who has issued that credential first, verify that it's effectively issued by the entity in the credential, and we'll check whether the status is issued or revoked or expired. And like this, you're sure that you can trust that credential or not. I would do the analogy, I don't know if you remember, I don't know if in the UK you had those COVID certificates where you would show an application and then you would tap on it to see whether the credential, the certificate was still valid. It's a similar approach, but for KYC credentials or accredited investor credentials, or I'm a not US citizen credential, etc., etc.
And is the customer, as the owner, responsible for keeping the credentials up to date?
No, yes and no. So in the case of those type of individual credentials that are, as I mentioned, you would the status of those credentials will be actually managed by the bank itself, meaning that in their usual annual review of the customer, if one of those credentials needs to be revoked, for example, is no longer an accredited investor, the bank would revoke that credential. But depending on the credential use case, it will work differently.
Now, the system you've described of a credentials-based onboarding process sounds a lot more sensible than the system we have at the moment. But in selling that to the financial services industry, you're up against a vast industry of its own, which is producing data to fuel the existing duplicative and highly expensive process. How confident are you that that your credentials-based compliance system will be adopted by regulated financial institutions like banks?
I'm not confident at all, to be honest with you, because of the complexity you just mentioned to me. I don't want to lie and say this is the best thing after sliced bread, although it is definitely that, technologically, conceptually, functionally. Of course, the friction is really around adoption, as everything, every new technology. Look at how long it took for blockchain to become 15 years ago what it was to what it's now finally, in terms of acceptance and usage by even banks who at the time were saying that it was all, bad things and that we will never use blockchain. So it takes time, and it's a technology that will take time to adopt. But I think what will happen, and that's something we have demonstrated with and that we agree with our partner Chainlink, for example, is that if you start issuing digital assets that are easier to manage because you have this verifiability of the issuer that is embedded, that is automated into the system, because you have that verifiability of wallets and the KYC status or accredited investor status of a wallet embedded into the system and automated and automatic, those assets will be faster to issue, faster to be tradable, faster to be transferable, will be less costly, therefore, and follow the money, right? Generally, when things becomes cheaper, you do have a progressive migration towards processes that are cheaper, that are more economically interesting for the intermediaries or the participant of the system. You have that with money. It used to take 3 days for settlement, for transfers of money. Well, people have come up with better ways to do transfers instantaneously of money and be progressively moving towards those instant payments. And just thinking that in some case it could still take a day for transfer has become almost impossible to comprehend for new generations because of those new technology having pushed towards more efficient processes.
I'd like to end by asking you a couple of general questions. And the first is about that problem of adoption. Standards, as you know better than me, take a long time to secure widespread adoption. Not only that, but they seem to multiply. There's the old joke, which you'll be very familiar with, about standards. There's so many to choose from. And we do see, as you've alluded to earlier, something of that being reproduced in the digital asset market with token identifiers. Now, on the basis of experience, we probably need to accept there are always going to be multiple standards or multiple identifiers, and there are indeed also going to be multiple interoperability solutions for moving those assets between the various blockchains. Now, we could take the view that the solution is to consolidate the standards into one super standard, or we could wait for market forces to do the work of driving out the bad ones so the good ones survive. But is there a practical alternative to consolidation or simply waiting, which is to make these various standards work together so that all different types of money, all different types of financial asset become portable between all platforms, all networks, both traditional and digital platforms? Is that a realistic prospect, getting multiple standards to work together?
It is, and I don't think we have a choice, to be honest. At the legal entity identifier level, in terms of public good, the LEI is pretty much the only identifier recognized by regulators, mandated in regulations. But it does have other counterparts, like the BIC, which I mentioned earlier, and also proprietary standards like S&P identities and so on. And what we've been doing at GLEIF since the beginning is understanding that the LEI will never only be the only one. And instead of trying to replace identifiers or existing identifiers, it was better to ensure there is some sort of mapping or interoperability between identifiers. So we have a series of mappings of identifiers on our GLEIF website that are performed by the owner of the other identifier and ourselves to ensure quality, data quality, and mapping quality, and are published as a public good on our website. And I think that will continue, and we will add more and more of those. We have this with ISIN, we have this with BIC, we'll soon have it with DTI and others as well. In terms of bringing that back to the digital asset discussion, this is the same challenge. You do have DID, so decentralized identity, today on various blockchains and various solutions, and we don't see the LEI or the VLEI as a replacement of all those different proprietary or blockchain-specific identifier. We see it as a way to anchor those decentralized identities into solutions on blockchains onto the real world with the VLEI, in a way that you can use a DID method on one specific platform, but anchored into the real world with a VLEI that in a verifiable way, so that you always know that this DID belongs to this entity. So similar to what we've done with BIC, ISINs, and other identifiers, but in a cryptographical way. Yeah, that's really an answer here. I would say that the LEI wants to play a role of a connector of identifiers and other identifiers, and interoperability is really the objective here.
My last question is also a general one. It's about the importance of standards remaining open. And again, if I look back through experience of the internet in particular, the protocols that have made the internet what it is, TCP, IP, SMTP, HTTP, the protocols that drive the internet, the World Wide Web, and email, these were all established by public bodies, not private entities. They remain open, they're free to use, and they've been very successful in averting walled gardens. And that in turn explains the success of the internet as a domain for businesses to establish themselves, get going and compete with each other. Now, the blockchain is an internet technology, and the debate which is currently going on, we've touched on it today, about whether a private blockchain is better than a public one, is in a sense, it's a kind of rerun of that debate 25 or more years ago about whether the internet should be open or whether it can be a system of walled gardens. How do you think about this question? How can open standards for blockchain networks be developed and maintained? And by open, I mean they're not owned by anybody. They might be governed, but they're not owned by anybody. People trust them. They don't cost anything to be part of. How can we reproduce that success of TCP, IP, SMTP, and HTTP in the digital asset blockchain world?
I'm convinced that, as you rightly pointed out, the private-public debate that we're currently seeing in blockchain is actually is going less and less, will ultimately faint into all blockchains will be public in a way and interoperable. The same way that we moved from intranet to internet, from private cloud to public cloud more and more, that as people get familiar, as people get comfortable with using open system like the public blockchain, and I should say public blockchains, because they're more than one, we will end up going in that direction of interoperability. The challenge with blockchain is that there are as many blockchains as people nowadays on the planet almost. And when you look at the announcements of big companies around the world, like Coinbase with its Base blockchain and others with their blockchain, it's counterintuitive in my view towards that future I've just explained will likely occur. Fortunately, you do have other, and the ecosystem, the blockchain ecosystem is very, very open data and open standards based, with a lot of code that can be that is published and that is reusable freely across various implementations. Examples that are EVM compatible blockchains who can reuse components of each other. You have Chainlink working on cross-chain interoperability protocol as a protocol, not as a proprietary, as an open protocol, not as a proprietary product, or cross-chain identity protocol, CCID. So I think there are a realization that there is a need for that interoperability across public chains and private chains, and people are working on it. And on the identity side, that's exactly what I believe the LEI and the VLEI can bring, is that public governance, neutral infrastructure, open access identity layer built by the regulators as a public good, managed by a non-for-profit foundation, the GLEIF, in a way that it can be used as a trusted identifying system, a trusted verifiable credential system across blockchains, whether they're private, they're public, making identity and credential portable. My view is that identity should never be a platform play. You should not lock an entity into a platform. It needs to be a protocol play, like emails, as we discussed. Your identity should be usable across various platforms, like a single sign-on as a company, if you see what I mean. And I think that's the direction of travel, and that's what we're working towards at GLEIF with the VLEI and the carry infrastructure, so the key event receipt infrastructure that has been built on purposely to be a technology and platform agnostic.
Alex Kech, CEO of GLEIF, thank you very much for taking the time to share your experience and your knowledge with the members of Futures of Finance.
Well, thank you so much for having me on this show.